What is a good stock investing strategy? That's what I want to talk about in this video and focus on beginners and those of you who are just getting started in the stock market with your investing. So on that note, first off, welcome. That is awesome that you are interested in doing this and taking control of your future freedom by starting to make your money work for you. So instead of always working for money, you're now looking to make your money work for you via investing, and that is absolutely awesome. Now, because this is for beginners, let me be upfront. This will be very, very basic. And while it's basic, it is still a way that is advanced in the sense of diversifying and managing our risk, because you don't want to get too risky with investing, because sure, it can pay off really big, but it can also crush you if you're not careful. So that's what I always find encouraging about the markets and investing is, can it be super, super complicated? Yes, it can. Does it have to be super, absolute, crazy complicated in order to accomplish some goals and manage risk and diversify at the same time? It doesn't, and that's going to be the pathway that I take you here. So understand that as you get more advanced in your understanding of the markets and in your investing, sure, maybe you want to branch off from what I'm about to talk about here. But again, via the title, this is for beginners, so I want to keep this very basic, but also keep this in a way that has some layers of protection against you, which I'll explain as we go. So let's just go to my desktop and I'll start to break down the very, very difficult math. It's not difficult. Let me show you. So you have some amount of money right now that you want to get invested. And for the sake of this, let's just call it $1,000 so we can keep the math extra easy. But whatever amount of money that you have, I want you to divide that by 2, and it is in yellow because that is our caution, which means that is one of our risk management solutions. Like I said earlier, sure, you can score absolutely huge if you go all into something and that one thing absolutely explodes. That is absolutely a possibility. But if it doesn't explode and it has a whole lot of problems, well, because you went all in, it's going to cause you a whole lot of problems. And that is why we're going to divide by 2. So we're going to take our money and set it aside in 2 different ways, because that in and of itself is now separating out. We are not going all in to one sector or anything. We're going to divide our money out. Or in investing terminology, we're going to diversify, and we're diversifying our money just simply by dividing by 2. So that's step 1. And for $1,000, that means we're going to have $500 here. We're going to have $500 here. Now we need to focus on, okay, well, what are we going to do with this $500, and what are we going to do with this $500? So after you've divided by 2, we're now going to take it 2 spots, growth, and this is where we're going to be focused on companies and stocks that have ability to grow and just grow pretty quickly, grow in pretty big ways. Maybe they're newer companies, maybe they're more so technology companies, but there's a variety of them. But the core being is that they're not going to be paying you any money via what's called a dividend, but they do have the potential to grow very, very quickly. So you always want to keep an eye on those growth stocks, and that's what $500 of this money is going to go to, or again, whatever half of your number comes out to be. And then the other is we want some passive income. Now, this is where we talk about dividends, and dividends are just in a very simplistic way. If you invest in a certain companies, those companies will actually pay you. I like to think of it as a thank you card, where the company just says, hey, thank you, here's a thank you card, but they put some money in it and you get paid to simply hold their stock, which does create passive income. Now, the catch here is these are pretty established companies. They're not like cutting edge or anything like that. So the growth factor isn't quite there. That doesn't mean that the stocks can't go up and grow over time, but they're not going to be nearly as potentially explosive as what a growth stock would be. So that's where we're getting some passive income via dividend stocks. Some people call them income stocks, but they're all, one of the same. So now that we have growth and passive income that we've split our money into, we're going to add another layer of risk management by doing ETFs. ETF stands for Exchange Traded Fund, and they're essentially a mutual fund. If you've heard of a mutual fund, then just look at it as an ETF as basically a mutual fund. If you don't even know what a mutual fund is, totally fine. Mutual funds are just a collection of stocks. They're just a collection of multiple stocks in a certain area. And that's why this is another layer of diversification via risk management. So we're not going to be going all in on one stock or anything like that. We're going to be going into an ETF that then gives you access to many stocks all at once. So again, in trading or investing jargon, it gives you exposure to many different stocks at the same time by just buying one of these ETFs. So we want an ETF for growth stocks, and we want an ETF for the passive income and dividend stocks. And then for our final layer of diversification and more so risk management, we want to have a minimum of a 10-year history. Now, I don't know, maybe you disagree with 10 years, maybe you think it should be longer, or you think 10 years is too much. But in my mind, I want to make sure that this ETF wasn't just created next week and is going to be poof, gone all of a sudden. But if you can look and see a good solid track record of 10 years or more, for me, that's peace of mind that, okay, this ETF has been around for a while, it's got a track record, it's been established. But like I said, if you want to change that around, that is completely up to you. But for me personally, let's make sure there's at least 10 years of history. So now we've got to go and find these ETFs. And I'm going to keep this broader because at the moment I'm recording this, technology is changing very fast. There's now AI type stuff coming out. So you can use a search engine, or maybe there's some sort of AI platform that you can use to accomplish the same thing, and maybe even better than what I'm talking about. But like I said, I'm just going to operate with what is available now, but take this general premise and then you can apply it to whatever piece of technology is existing whenever you watch this video. So I'm just going to use Google, and who knows, maybe 10 years from now, Google doesn't even exist, and this will be kind of funny, but maybe it's been replaced by something else. But I'm going to use Google, and let's just walk through how you can find both of these types of ETFs. So let's just first start off with best growth stock ETF, okay? And this is going to bring up all sorts of things. And let's just click on one of these. And this is what I would recommend. Just type in something that simple, and then you go and you start to think, okay, well, what are other people saying could be really good ones? So let's just click on this, and I'm doing this. Let's zoom in here so you can see it better. So right here, we have several of them that they're listing. And step number one that I would say, and just keep it in mind, and this isn't universal, but have you ever heard of the company before? So in this situation, Vanguard, very, very popular. I've definitely heard of them. So now that doesn't be the be all end all, but like I said, that's just kind of something for me where I like to find a little bit more comfort. But if you are brand new and a beginner, you've probably heard of none of these. So that's not necessarily applying to you, but that's why, again, we're looking for that 10-year track record, which I'll show you how to find in a little bit. But you can just go through here and start to figure out where some of these stocks might be and ETFs. And you can see right here, let's just start with this one. So Vanguard, Russell 1000, growth. So that's what we're looking for, is we're looking for growth. All this other stuff, it has importance, but what we're after is the growth. But again, if you use that the Google search terms of what I showed, you'll get these growth. And a couple things here. The expense ratio is what it's going to cost you. So 0.08%, that is very, very cheap. If you were to go and hand it to some sort of financial advisor, it's going to be way more than 0.08%. And what's a little shocking here, not totally shocking, but you actually do get a little bit of a dividend, 0.81%. So not a whole lot, but again, these are not income stocks. These are not passive income generators. They are focused on the growth. So if there's a dividend at all, you wouldn't expect there to be a very big dividend. So going down here, well, let's just start here. VONG. So you're interested in that. Okay, well, what's the next thing we have to focus on? Well, we have to focus on, is there any sort of track record for this? So the nice thing here is if you hop over here, so VONG, and I'm just using Yahoo Finance, but you could use any of them, but this is one. And the key thing here is you come down here, and I want you to click right there on Max, because Max is going to take you and through the entire history of the ETF. So by clicking on that and going back here, you can see the date. You see 11, 12, 13, 14, 15. So this thing has been around since 2010. So that automatically qualifies, at least for my criteria, because this thing is over 10 years of history. This thing just didn't start last week. It's been around for a while. And that's going to be the key dynamic, is just running that Google search or whatever piece of technology you're using, finding these ETFs, and then going and checking whatever that time frame is, hopefully 10 years. Now, when we go to the income stock, it'll be a little different because we're gonna need to focus more so on that dividend amount because that's gonna play a vital role because, well, we're looking for passive income and the dividend is telling us how much passive income you'll get. But for the growth stocks, it's pretty much, hey, find something growth, find something where you like it, and if it makes sense to you, maybe for whatever reason, this is what makes investing so interesting, is maybe you think international, you think companies outside of the USA are going to really be growing. Well, then you could look for an international growth ETF. Maybe you think, no, I think the USA or I think this country or that country is going to explode. Well, then you could look at growth ETFs for the USA, for Canada, for China, for whatever country, for Brazil, whatever countries you think may really pick up, then you could look for something that specific. But general, I would say that keep it broader with international. But again, it's not totally the end of the world if you want to do that because we've divided our money by two. We're looking for track records. So there is a bit of, diversification in and of itself. But if you want to keep it just broad, you would just want to look for simply an international growth ETF. But let's now go and find ourselves some passive income ETFs. Okay, I lied. I want to do one more growth the more I think about it because it'd be great to find one that does not have 10 years. But what I want to do here, because I've never heard of First Trust. Who is First Trust? I have no idea. So are they somebody that's new on the scene? That would be my guess, but let's go check it out. So first off, again, now this expense ratio, a bit more, 0.58%. Now still not huge, and this one is actually going to cost you money to hold. How so? Well, look what the yield is, 0.57%, yet the expense is 0.58%. So this one's actually going to cost you a little bit of money to hold. But to be fair to it, the 10-year annual return is right now just under 14%. So sure, it costs you a very, very small amount, but if you're getting the 13.8, then that'd be pretty good. Again, this is just a 10-year average, and past history is not a promise of what's going to happen in the future. But yeah, like I said, First Trust, don't recognize that name. So let's go check this out, QQEW. So let's hop again over here to QQEW. And I'm doing this, like I said, without pre-planning any of this because I wanted to have that organic feel like I'm just kind of sitting down next to you and we're doing it together. So I really don't know what we're going to see here, but again, that's because on purpose. So again, let's come down to max. And I'm guessing, let me know in the comment section, do you think QQEW has at least 10 years? I don't think it does. Let's see. Wow, I look stupid. Who are these people? This thing's been around since 06? Wow. And that's... I know, Clay, whatever you say, you totally pre-planned this. I understand because this worked out really perfect and making me look like an idiot and why you always want to check. So shame on me. This thing's been around since 2006, but there's another one where if, you wanted to, and I should also illustrate here. So let's click on holdings and you can see right here, sector weightings. So this is what I mean by diversification. You're buying one thing, but look at this. It's giving you 14%, again, going back to the terminology, exposure to consumer cyclical. Financial services, 1%, not a whole lot. What's the other one? 14.6 to healthcare, 10% to communication services, 35% to technology, 10.34% to industrials. So that's what I mean. By buying this one thing, you're getting access to all these different sectors. Now let's hop over and look for those ETFs that are based on stocks that pay dividends, and therefore the ETF itself is going to pay us a dividend, and it is definitely going to be a little bit more than what we just saw. But let's go hunt some out and let's see what we can find. Now we don't need to make this overly complicated. Let's just come up here and instead of best growth, just type in best dividend. And let's see what we find, and we'll come down here to this one. And right here we have a list of them. And first off, right off the bat, we have Vanguard, which is familiar. But we start to notice some things over here is expense ratio, yeah, a little bit more than a 0.0 something, but 0.22%. But the dividend yield now, look at that, 4.47%. Now, depending on how new you are, look at this as an interest rate, but not like an interest rate that you would pay somebody, rather an interest rate that is being paid to you. So that's how you got to view the dividend, an interest rate being paid to you as a thank you for being an investor into people's stocks. So this ETF is paying you 4.47%, but they are charging you 0.22. So in order to get what the actual yield would be, you would need to subtract 0.22 from 4.47. So that would be 4.25, if my math is right there, percent that you're actually getting. So let's just scroll down here, look at a couple other ones. Invesco, heard of them. Wisdom Tree, think I've heard of them. FCF Advisors, I don't know if I've heard of them or not. Now this one has me a little leery because that's a huge dividend right there. And they're only charging you 0.59%. So again, what would the actual dividend be? If you said, well, Clay, the actual, and I hesitated there to give you a chance, but if you'd say, well, the actual dividend would be, you need to take this number and subtract it from that one. So we'll put the subtraction right there. Then perfect. That's how you would figure out that, and you pass that quiz question. So nothing like a pop quiz, but yeah, I'm very curious because I've never heard of this FCF. And I mean, 10%, that's pretty big. But you can also see the 5-year annualized, well, right there I think is a clue. If they can only give us 5 years, this thing's probably been around a little while. And you can also hear an example of international. But the 5-year, you can see it's not growing much. So that is why this would not be a growth ETF, because think back to the other one was at what, like 13.88. This one is at 1.85. But it's being balanced by the fact of you're getting higher dividend. But let's go check out TTAI and see if we can figure out what's going on here. So TTAI, I'm not going to make any predictions. I've already looked dumb enough once. Yeah, okay, so this one started in 2017. So this one's got about 6 years worth of history on it right now. Maybe you think that's enough, but that is a consideration for me. I wouldn't be interested in it just because not enough of history. But let's go. Now this is one I do own, so we'll take a look at this. And this one is based on US stocks. So right there, it gives away in the title, US dividend, SCHD. And this is, this is why I like it, because you're getting a good 10-year growth. So you're trying to split the difference. But are you getting some, 10% dividend yield like we saw on that one? You are not, but it's not quite 3.64%. What do I mean? Why is it not 3.64%? If you're saying, well, Clay, because we've got to subtract that out to figure it out, then very good. You've passed that pop quiz question, and you really do understand how the expense ratio works in relation to the dividend yield. So yes, this one, in other words, is very, very small, 0.06%. Yet you're getting a quality dividend, and you're getting a good average 10-year. But again, to reiterate, as a beginner, this is looking backwards. That doesn't mean that this is always going to be 11.6%. But and I'm cheating here, I do know. But just for example's sake, let's come up here and check on SCHD. SCHD, because I'm actually curious, how long has this been around? Yeah, this one has been around since 11, but that first one that I never heard of has been around since like 06, which is crazy. So this one would definitely pass that test of being around long enough. But really, it just comes down to what sort of dividend yield do you want? Is that going to be enough for you, or are you going to want something bigger? So that is how I would go around this beginner's stock investing strategy. Take the amount that you have, divide it by 2, and then take some of that and put into a growth ETF, put some of that into a passive income ETF, or again, a dividend ETF, and that gives you good diversification. And let's say you come along and now you want to add in another $500. Well, take that 500, divide by 2. Now you put $250 more into an ETF, you put $250 more into the other ETF. Now, if you, like I said, the more you get experienced, the more you get your feet wet, maybe now you want to add in a third ETF. Maybe you want to start to add in individual stocks, but I would not do individual stocks until you feel very, very comfortable with all this. But if you want to add in another ETF, so maybe, for example, growth, you want a USA-based growth ETF and then an international growth ETF. You could do something like that. And you can start to expand out your tentacles more and more. But just from a getting started beginner standpoint, I would keep it to 2 ETFs, and you just divide that money by 2, and that'll give you a good firm foundation from which you can build from. So I hope this helps. If you have any other ideas or questions on these sorts of videos, by all means, leave those down in the comment section below. If you know of any good ETFs that you would recommend, also leave those down in the comment section below. And just make sure that you or tell us what they're called so we know whether they're growth or some sort of dividend ETF. But yeah, leave those down below. So thanks for watching. I hope this helps. And like I said, let me know if you have any questions. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only 1 losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.